Welcome to this explainer. Today we're jumping right into a really fascinating set of sources that take us on a journey. We're going from a quick refresher on investing fundamentals straight into the absolute high-stakes survival tactics of day trading. So whether you're just looking to refresh your core strategy or you are actively trying to bulletproof your capital in the wild swings of the market, this walkthrough covers exactly what you need to know.
We've got to start right here with a question that addresses a very real financial anxiety for a lot of us. Why let your savings sit idle? I mean, you work hard for your money, right? But if you just leave those savings sitting there doing absolutely nothing, you're actually losing out on future returns. You're missing out on wealth generation. The core idea from our sources is that instead of letting those hard-earned resources stagnate, you need to put them to work to earn a return and actually secure your future goals.
Here is our roadmap for today. 1. The basics of investing. 2. Entering the stock market. 3. The trading survival rule. 4. 5 risk management techniques. And 5. Automating and mastering risk.
Section 1. The basics of investing. Okay, let's lay the groundwork for why and how we invest. The sources highlight 3 golden rules. They're super simple, but man, are they powerful. First, invest early. Literally, the sooner you start, the better, because it gives your principal and the interest you earn on it way more time to accumulate and grow. Second, invest regularly. Make it a habit. And third, invest for the long term, not the short term. It's really about giving your wealth the runway it needs to compound over time.
Now, when you actually go to deploy that capital, you have to pick your timeline. On one side, we have short-term, highly liquid options. Think savings accounts, liquid funds, fixed deposits with your bank. On the flip side, we have long-term growth vehicles, things like public provident funds, bonds, and mutual funds. Basically, your choice depends entirely on when you're going to need to pull that cash back out.
And we really want to anchor these core concepts to our source material today, which comes directly from the educational resources over at Flame Investment Lab. They make a fantastic point. Unless you are crystal clear on these basics, you're just going to end up wasting your time and worse, losing your money.
Section 2. Entering the stock market.
So, once you have the basics down, how do you actually cross the threshold into the market? Our guide from Kodak Neo outlines the exact mechanical steps to get in. Step 1 is securing your DMAT account. That's what holds your funds and your securities electronically. Step 2 is learning to read stock quotes. And remember, these prices aren't static. They are constantly shifting based on supply, demand, and overall economic sentiment. And finally, Step 3 is determining your entry point and actually executing that trade.
Section 3. The trading survival rule. All right, so now we're making a massive pivot. We're moving away from the patient, steady world of long-term investing straight into the absolute high-stakes arena of day trading. And listen, if you take nothing else away from this explainer today, please remember this. The real secret sauce that separates successful traders from entirely blown-up accounts is ruthless risk management. You really aren't looking for some magic offensive strategy here. In the wild swings of the day trading market, capital protection is literally the only element you have 100% control over. It is the definitive defensive play that allows you to survive to trade another day.
Section 4. 5 risk management techniques. Okay, let's dive into this. How do you actually protect that capital? Technique number 1 is to set a maximum loss limit, both daily and per trade. Think of this as drawing a hard, non-negotiable line in the sand. Our source material from Switch Markets gives a really great practical example. You might decide to risk no more than $200 on any single trade and absolutely no more than $500 total in a single day. By enforcing this kind of ironclad discipline, you ensure that one bad day doesn't suddenly spiral into a complete financial disaster. I want to burn this specific number into your brain right now, 1%. This is technique 2, the 1% rule for position sizing. The math here is incredibly simple but profoundly important. Let's say you have a $10,000 account. Under this rule, you risk a maximum of $100 on any given trade. Why? Well, because even if you hit a terrible losing streak, let's say you make 5 bad trades in a row, you've only drawn down roughly 5% of your total account. Sure, it's painful, but you're still in the game. It is survivable.
Technique 3 centers around a famous trading mantra: plan the trade and trade the plan. Before you ever even think about clicking buy, you need a strict blueprint. This plan has to detail your entry price, your profit target, and crucially, your stop-loss exit. By deciding all of this stuff up front, you completely remove those dangerous, impulsive emotions from the equation once your money is actually on the line.
Which brings us to technique 4. And honestly, this one is non-negotiable. The stop-loss order. We all know it as the ultimate safety net. It's an order that automatically closes your position at a preset price if the market suddenly turns against you. It instantly caps the damage. And the best part? It doesn't require you to sit there staring at your screen, trying to fight off a panic attack while a trade goes south. It just handles it.
Technique 5 is to diversify your trading strategies and instruments. Look, we've all heard the saying, don't put all your eggs in one basket. Well, in day trading, this means spreading your capital out across different assets or uncorrelated trades. If you bet the farm on one single stock and some terrible news breaks, your day is completely ruined. Diversification is what offsets those sudden, unpredictable drops in a single stock by spreading the risk around.
Section 5. Automating and mastering risk. Now, it's one thing to mentally know these defensive rules, right? But it's entirely another to turn them into unbreakable habits. A lot of active traders today actually use algorithms or expert advisors. And what's fantastic about this is you can program these exact strict parameters right into a trading bot. You code in that 1% position sizing, so the bot automatically calculates the safe lot size for you. You enforce automatic stop-loss orders the very second a trade opens, and you can set a daily max loss shutdown. By programming this in, you are completely removing human temptation and human emotion from the driver's seat.
But hey, what if you're trading manually? Mastering these rules is an ongoing journey. The sources highlight a really clear path for this. You start with self-education through articles and books. Then maybe consider formal courses. Seek out mentorship. And finally, and this is huge, practice on a demo account. The source material strongly advises using a demo account with virtual money to rigorously test your risk rules before you ever put a single cent of real capital on the line.
And that brings us to a really powerful quote from Bernard Baruch. He said, "In trading and investing, it's not about how much you make, but rather how much you don't lose." I mean, wow. That just brilliantly illustrates the entire survival philosophy we've been talking about today. At the end of the day, it all comes back to capital preservation.
So I want to leave you with this one provocative thought to end our explainer today. Are you truly managing your risk on every single trade? Knowledge is power, but honestly, only if you actually apply it. So I challenge you to reflect on your own financial habits right now. Swallow your pride, enforce that strict discipline moving forward, and defend your capital. Trust me, your future self will absolutely thank you. Thanks so much for joining me on this explainer, and I will see you next time.